Sometimes the analogy fits so well, we just got to use it, if only to teach people what's really happening in the market. Sure, we can use the averages. They tell the tale of some of the day's action. Dow dipping 41 points, S&P declining 0.54%, NASDAQ losing 0.84%. But today I saw something worrisome, something that bothered me. I saw a hammered market, a market where the buyers have gotten drunk as a proverbial skunk, buying the worst of the worst. And when you get hammered, you know there's going to be a nasty hangover on the way. Now, look, for most of the year, this market's been sane, sensible, a sober evaluator of merchandise. And that's why the Magnificent Seven racked up such big gains. Go back in time and remember when they were first running. It was literally one of the worst weeks of the year when the bank dominoes were falling. The rotation in the mega cap techs made tons of sense. At that very moment, we thought there'd be a credit crisis. Any company with a need to borrow money, a customer base that needs financing, looked like it was toast. So people dumped the banks and any companies that needed to borrow and gravitated to what? They gravitated to Alphabet, Amazon, Apple, Meta Platforms, Microsoft, NVIDIA, and Tesla. See, these companies spew cash. They're practically ATM machines. Even Tesla, which used to be desperate for cash, but now has a pretty good balance sheet. The Magnificent Seven didn't just appear on the horizon one day out of nowhere. They were selected by a market that was sober, a sober judge of what could survive pretty much any downturn, as it seemed like a recession was suddenly in the cards. Then as we got further away from the mini banking crisis, the market broadened out, and investors collectively got a nice buzz going. You could say the market grabbed a couple of Coronas and took its time drinking them. You can drag these sips out and maintain the buzz without getting plastered. That's a little advice there. Mind you, you can't drive. You can't discern the road like that. But you can buy more aggressive stuff and get a designated driver to take you home. And that's when we decided we could buy the artificial intelligence ancillary stocks like ServiceNow and Adobe, the highest quality techs that didn't make the Magnificent Seven cut. We lapped up cybersecurity like CrowdStrike and Palo Alto. We reached for Eli Lilly because of the chatter about GLP-1 success in reducing weight and treating diabetes. We grabbed AMD as an alternative to NVIDIA, glommed onto Cadence and Synopsys, partners NVIDIA. We gravitated to Walmart and Costco, the best of the retailers. And we fell in love with General Electric as a way to invest in aerospace. But not everyone at the party acts responsibly, do they? And some are just not content to be buzzed. There's always some jokers who want to cross the line, and when they want to get hammered. And that's where we are today. The hammered investors have taken over, and they're drinking some sort of Sterno-like punch out of a garbage can.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.